Hello, everybody. Kirk Spano, Investing 2020s. Going to start today with some updates about how the month is going to go. I am catching up on several articles, and we will start with one of those today. But I will be spending the second half of June in Las Vegas. I get there on the 15th, and I am scheduled to come back home on July 1st. I will be playing in the World Series of Poker. At least 3 events, probably at an event at the Venetian or maybe Aria. We'll see. So I will be playing a lot of poker those last 2 weeks. I'll take about every third or fourth day off to catch up on work. I'll be checking into the chat rooms once or twice a day. And because it's West Coast time, I'll probably check in at about 8 or 9 in the morning Vegas time. Then it's off to poker, usually from about 10:30 in the morning until very late at night. And I won't be very accessible. So I will have a couple of articles popping out. But in general, it'll be a pretty light schedule the second half of June. If I happen to hit my target winnings, last year I won about 20 grand. My target winnings this year are 40 grand, would like to double it. I will probably stay in Vegas an additional 2 weeks and play in the main event. So my general rule is I have to win my way into the main event. I have not won my way into the main event since 2003 and 2002. Or might have been 3 and 4. So I haven't played the main event yet because I sold my tickets back then because I was getting divorced and needed the loot. So I'm going to go out there and give it my best. So we'll see. In any case, Macro Dashes is the article that I'll publish later tonight. And then I have Stocks of the Week this weekend. We already saw the retirement income options update for the May expiration. And I think that what we talked about last week is pretty important. So we're going to review a little bit and then back it up a little bit, because I don't know that everybody completely understands why the debt ceiling getting solved is actually a problem. So first off, we knew that it would eventually get solved. They had a minimalist deal that was enough to get 320-ish votes. So they got 100 votes more than they needed to pass it. And they essentially kicked the can down the road about 2 years. So we're not going to see another debt ceiling issue before the presidential election. Some of the hardliners on both sides did not like that. That's really the only people who voted against this in Congress was a far left group of around 40 House members, and then a far right group of around 80 House members. So the extremes are pretty interesting to note. There's more extremists on the right than there are on the left. I think we knew that, but they both make a lot of noise. It looks like we have plenty of centrists that can reach the middle. So I am optimistic that a couple of things get solved, especially if the Democrats pick up another seat or 2 in the Senate in 2024 and hold on to the presidency. At that point, they have to do some serious negotiations about the budget to keep the deficits to around $1 trillion per year or less. It would be nice to be a little closer to balanced, but with so many baby boomers retiring late in the decade, we've talked about the potential for a baby boomer retirement crisis around the year 2030. We still have to keep an eye on that, but the theories that I've been offering you for the last several years that the United States would eventually turn the corner and move towards a balanced budget, have a millennial-led boom in wealth creation, fourth industrial revolution, and carbon capture and clean energy and decarbonization in general, leading the growth of the economy, and we'd go on a pretty long-term bull run. Now, in the coming weeks, though, the Treasury has to start selling bonds, and it's going to raise between $500 and $700 billion by around Labor Day. So there's a lot of bond issuance coming. That sucks money out of the banking system and out of the financial system in general. So that's money that really can't be used for investing, because most of the money going into the banking system is just to shore up their balance sheets. At some point, I do believe that this banking crisis comes to a head. I don't think it's happened yet, and I will show you why in just a second. The money that the Fed has to raise over the summer, or the Treasury has to raise over the summer, and the Fed's probably going to buy some of that debt. I don't see how they can avoid it. Maybe they do. I don't know that we're going to find enough private buyers. So that is running right into quantitative tightening, and about 700 stressed regional banks on top of the summer doldrums, which is usually lower liquidity anyway, and is why we've seen so many August corrections that are rather large. So I think that the next 3 months could be tough. I think the update today is typical of the start of a month. I think by tomorrow, the market might be giving back. So if you have positions that are around even or profitable or closing in on even, and you just want to reduce your percentage asset allocation in something, you may want to do that. You may want to look at your computer in just the next couple of minutes, because I think that as all this liquidity is sucked out of the market, and over the next 3 to 6 months, it'll be well over $1 trillion. The market is really going to have to sort itself out and consider who the real winners are. Now, we have seen the top 10 or 12 market cap stocks go up, everything else kind of drift down, and small caps get crushed. In a lower liquidity market, that is the harbinger for the next bull market, right? Because we have a pullback, then we go forward. Small caps have always led, and generally have led by a lot, into the new bull market, which I've told you I think will be starting late this year, probably, or maybe in January. With the small caps being so beat up, and with people having to decide where to invest their money, you have to ask, can the large caps, the mega caps, continue to pull the averages up while everything else languishes? I don't think that it can. Historically, that's not how it's worked. The large caps are the last bastion of the market before the end of a bear market. And the end of a bear market is usually the worst kick in the teeth. So we saw the stock market fall throughout 2022, and NASDAQ particularly, and Salesforce have pulled the market back up, but only from the top up. It's like stretching the market. It's not as if everything's going up. The S&P 500 is market cap weighted. So when the giant dozen or so stocks go up, it just pulls the average up. If you take a look at the equal weight S&P 500, it's down. So just throw out those top 12 stocks and the stock market's down. And you can see all the charts that I've been showing you that have turned over, but they haven't had that last leg down. I think that last leg down is coming in the next 3 months. So I would be selling the rallies on anything that isn't on the very short list, or that you can't justify owning long term. Anything with a growth rate that's below the rate of inflation, so I'd say anything with a growth rate of about 3% or less, you just can't own. You're going to get crushed in no growth stocks. That's what's coming over the next 3, 4, 5, 6, 7 years. The era of super low interest rates is probably over until we have the next crisis. And I don't really see another crisis, short of a war, happening until the baby boomers are all on Medicare and we are forced at that point to make some very hard decisions. I think we're moving in the direction of making some of the easier decisions, some of the congressional agreements that need to come. I think you're going to see President Biden run on getting rid of loopholes for the super wealthy. I think he's smart enough at this point, because he hasn't been talking about it. He's smart enough at this point to not talk about tax increases and just talk about closing loopholes on the richest 1%. I've told you that if they do that, and I've run through the list of things, carried interest, capital gains over $1 million a year, 1031 exchanges, step up in basis on assets at death, the estate tax. There are all sorts of things that the super wealthy have the accountants and the lawyers to avoid, and the tax laws are on their side to begin with. So if they just get rid of the loopholes that the super wealthy use, and I'm talking people that earn 7 figures a year, and they keep government spending growing at less than the rate of inflation, we'll have a balanced budget sometime in the early to middle 2030s. The way that the dollar works, we've been over and over again for the newer folks. Back in 2012 and 2013, I told people on MarketWatch that there was a bull market in the dollar coming. The dollar has increased in value against a basket of other currencies for the last decade, even in the face of people screaming devaluation of the dollar. It's a bullshit argument. It's always been a bullshit argument. It will always be a bullshit argument. The dollar is and will continue to be the strongest currency on earth. And if we hadn't been holding it back by manipulating the financial system and generating debt, the dollar would trade 20 to 30% higher right now. We got a taste of that last year. We're getting a small taste of it right now. And finally, there are some hedges on the dollar being too strong that should keep us close to par against the basket that we use to measure against, euro, yen, things like that, DXY. What are those hedges? Those hedges are Bitcoin in particular, and now the new BRICS currency that is China-led. But I want to put some things into perspective. Nearly 80% of all currency-based transactions on the planet, which include trading goods and services but having to convert a currency, involve the dollar on one side or the other. I don't know how anybody could argue that didn't make it pretty clear that the dollar was the reserve currency. Now, there's two ways to think of the reserve currency: the use of the currency and the storage of the currency in sovereign balance sheets. So while the number of dollars on China's balance sheet in particular has fallen, the rest of the world has actually been about even since 2014 when China started cutting their dollar holdings. There isn't a viable alternative to the dollar for transacting business unless Bitcoin explodes, because the BRICS currency, which is China-based, was based on the notion that you can trust China. Go ahead and laugh right now. So the amount of BRICS currency, and you can Google that, is never going to be substantial because it'll only be about half of China trade. So to the extent some of these countries do business with China, they'll have some renminbi, yuan, on their balance sheet. And they will do it by using a shared currency they're calling BRICS, but it'll be a minimalist thing. It'll be a small hedge against the dollar getting so strong that it crushes their economies. And it's smart for them to do that because emerging markets got crushed when the dollar surged. We did a trade in that, made a couple bucks, backed out of it a few months ago, and I think we're going to end up buying quite a bit of emerging markets stock in the next 2 quarters. Because as the dollar goes through a cyclical decline, as we end up having to bail out our banks, your emerging markets should do very well. Our small caps will do very well in addition, to expand on what I said earlier, because people aren't just going to throw money at the biggest stocks. In a period when foreigners are looking for investments, and they're generally very sophisticated, they either look for safety or growth. And in the expansion that's about to start, with a huge move towards decarbonization using fourth industrial revolution technology, and the AI revolution that's coming, that's going to make us a lot more efficient, more productive. But still, you got to remember, AI can't go out and build a road or rebuild all the real estate. Can eventually do some of the farming, though. That's interesting. So between small cap investing at the start of a bull market, emerging markets investing as the dollar drifts down a little bit into a economic expansion, this is a story that we've seen over and over again since World War II. So don't buy the trader narratives unless they agree with me. Because I'm telling you right now, the small caps have a huge ramp because they've been beaten down into oblivion. This is the worst bear market in small cap stocks in my career, and I believe maybe ever. I would have to double check that. But somebody on Bloomberg was saying it's the worst bear market in stocks ever. I have not verified that, but it could be the case. A lot of those small cap stocks are going to lead the way on decarbonization. And as Bill Gates pointed out, whoever comes up with the killer apps using AI are going to be the huge winners. Now, there's a couple of things that are important there. The actual AI chat engines are going to be from the big companies because they can afford the equipment, right? You need supercomputers to do this. So small outfits aren't going to actually generate the AI. But the developers, the small developers, people who maybe use Unity or do it themselves or any other app development platforms, are going to come up with ways to use AI that are going to be so instrumental in your life in a few years that they make a fortune. So just like we have several different messaging apps for our phones, WhatsApp, iMessage, right? Whatever the Samsung one is called, Messenger through Facebook, right? People bounce around, use 3 or 4 of them, Snap, go through them. Same thing's going to happen with AI. There are going to be 7, 8, 9, 10, 12 AI assistants for you to use that are going to make a lot of money. had a talk with the author who wrote the article on the singularity, Rami Talblasi. Let me look that article up here real quick. I interviewed Rami Tarabolsi a couple days ago, and I'm going to be putting that up on the YouTube page. Our talk really centered on AI, although we talked about a couple of other things. So I strongly recommend that you read this article. I just linked it in the chat, because what's coming is so profound that it's hard to wrap your head around. So coming out of this slowdown, where the S&P 500, depending on what the traders do, could go down to around 3,000. For sure, it's going to get into that 3,600 to 3,800 range. I'd be shocked if it didn't. I mean, if we don't get a correction from this, then the Fed has to raise rates even more. They need to see a capitulation to set up for this next rally, which could last 5-6 years with a pause for a boomer crisis, and then resume for 5, 6, 7 years after that, just like after the financial crisis. I think we're really looking at the potential for roughly a 15-year bull market coming out of this liquidity drain, and with a speed bump bad year or two at some point to finish off dealing with the boomer retirement. And remember, I told you, part of the reason that I believed, and I asked the question in real time at the time, that we printed so much money during COVID, way more than we needed. Rami and I talked about that. I was shocked that he thought the same things that I did, was to pull forward the bailouts of the future. Let that bailout money work for an extra decade. Get the value of the compounding. I think that's what was done. They're not talking about it yet, but somebody's book will say it someday. And when that book says it, you can go, oh, my God, Spano talked about it way back when it was happening. So in the shorter term, here's some things that you need to realize, and I want to emphasize how bad this liquidity issue could be, because I'm right in the middle of it. I have a call after recording today with one of the private equity firms, and we're going to talk about how we're going to go about raising money to buy some of these distressed notes and build a couple projects. So let's take a look here. We've talked about the regional banking system. There's about 700 banks that are going to take pretty significant losses on their commercial real estate. There's 43 banks right now on the trouble list. Banks that are being told, you guys got big problems. You're at risk of needing a bailout. And as you know, the bailouts will come with wiping out the shareholders. They're not going to back the executives or the shareholders. All they're going to do is protect the depositors. Over at Russell, they talked about the unintended consequences of bank runs. Well, one of those things will be that the Federal Reserve has to come to the rescue again, which they have done recently. Here's what Federal Reserve policies look like in the last year. This is the QT that overlapped with the bear market. This is the bailout of those banks a month or two ago. And then look at that, sucking that money right back out of the system. As you can see, the money that went into the system to help SVB and First Republic, whatever the other two were called, they're not even important anymore. They don't even exist anymore. Spiked up, they sucked it right back out. We're going to even be lower than this amount imminently. And then some other bank's going to get into trouble, and it's going to spike up to bail out their balance sheet and their depositors and come back down. So you're going to see a zigzag on this line, which is the Fed balance sheet, probably for the next year. But at some point, because the economy has slowed down enough and they want to stimulate it probably into the presidential election, you see a bull market begin. And of course, the stock market will anticipate it. So as soon as we get that negative quarter on GDP or a zero, the market will go, oh, Fed's got to tighten. The Fed's got to loosen. And they will, like they do every other time. But this is serious enough that I think you're going to see so much destruction in the banking sector that it actually comes out healthier. So as I talked about before, our banking system is just too big. We are definitely overbanked. We have the most banks per capita in the developed world. And they have to deal with all this commercial real estate that's going to take a couple of years to sort itself out. As I told you, when I was in San Francisco, I looked at some real estate, and we are seeing banknotes at 30 to 70% discounts. What does that mean? That means that the banks are owed way more than what the buildings are worth. And because of the hybrid nature of white collar work now, we're never going to need as many commercial offices ever again. And especially since AI is going to allow almost everybody who has a white collar job to do it from home at least part of the time. And management is trying to figure out how to navigate that, because you do need people in the office just interacting, generating ideas, developing relationships, getting mentored, being trained, things like that. Will most people end up in the office 4 days a week or 2 days a week or 3 days a week? I don't know. There's a most. I think each company will do it the way they want to do it, but it will definitely mean that you don't necessarily need a dedicated office if you're only going in 2 days a week. It might be a lot more cubicles again, rather than building walls. And we also know that we have a pretty dire shortage of living space in this country as the population drifts up, not so much through birth, but by immigration, and more immigration coming. Millennials raising their families and not wanting to live in an apartment style anymore, buying the boomer houses. We need a lot more houses. We need a lot more apartments. And that's going to be the case probably for a decade. And until the boomers start to pass away, real estate markets should be pretty firm. The commercial real estate, though, is going through a transition to be mixed use, a lot of residential, on top of some offices, on top of some retail. And as I've been investigating that, it is pretty apparent that the people who are going to do that are the private equity firms, some big development firms, and they're not going to pay 2019 prices for this real estate. There you go. So REITs are already getting down to the financial crisis lows for the office real estate, and I think they might go down another 20 or 30% yet. We'll see. The banks will hold out for a while, and then they'll finally say, well, it's not just what we're owed, it's what it's going to cost to rehab the building or redevelop the building. And you are going to see some amazing deals. So if you are an accredited investor, you should be getting in on some of this real estate on the private market. I have a few things for you that I can show you. So contact me if you're interested. And I know other people who can show you other things as well. So right now, the banks are reacting to everything that's going on. And it's the people with piles of cash that are going to win. The firms I'm working with have piles of cash, and they're raising more because they'd like to leverage the money 2-to-1. Not big leverage, just 2-to-1. They're looking at internal rates of return of 15% and up, and expecting to roughly double their money on top of that when they exit in 5 to 7 years. So these ticking time bombs, I think, are quite largely hyperbole when it comes to what's going to end up happening in the long run. But in the short run, it's going to feel like that. You're going to see a couple dozen more headlines of banks going under or being forced to merge. And I think that that's going to be common. So we have a couple of investment themes here then. The first one is the banks aren't ready to be invested in yet, at least not KRE, right? The regional bank ETF has kind of been jitterbugging around, but I think it has a leg down yet, looking for a price around 30. And that would be very interesting to me. There are a handful of banks that I like because of their mix of business. I pointed out Fifth Third, not quite where I want to buy it yet. But if you've been following the news on migration patterns, you will have seen that rents have stopped going up in Florida. And then on net, people have started to move back to the Midwest from the expensive states and the climate risk states. And that is why we are investing primarily in the Midwest, building a subdivision outside of Mayo Clinic, building apartments on the busiest road in Wisconsin, buying distressed banknotes at 30, 50, 70% discounts. This type of investing should get your attention, and you should be looking into it, because large cap stock investing is probably not going to be the best place to be. I don't know, the rest of the decade, maybe. I really see a huge shift coming, because if the Fed isn't going to outright print money, right? They'll do the bailouts, they'll do the normalizations, and that's really what this is, a great normalization. And then they continue with QT to try to prevent the balance sheet from running away on them. I really think it's going to be a choppy balance sheet for a while. As the United States moves to a lower debt regime over 10 or 15 years, it's going to be important in terms of relative performance to be in the right spots. These small cap stocks I've talked about over and over again, the emerging markets we've talked about. And I think that REITs, which I haven't liked in quite a long time, but especially the REITs that are on our list, are very interesting. I would point out Digital Realty Trust just because I saw a short thesis on it. I've been waiting for Digital Realty Trust to have two things happen. One, they need to move to a slightly different model for how they build, and We just need to bottom out on stock price before the next era of digital data centers takes off. So the digital data centers are kind of troughing out right now because they were overbuilt for a little while. And now everybody pulled back. And this is a cyclical sort of thing that happens in almost every industry. It gets overbuilt, they back off on spending, then suddenly there's a shortage. That shortage in digital data centers will appear in the next year or two. The market will probably sniff it out ahead of time. But right now, they're busy with beating them up. The need for digital data centers is going to explode again as AI and IoT take off to a whole new stratospheric level. Not so sure that Micron is the ultimate winner, though it's a great company to watch. These digital hard drives, right? Seagate, Western Digital, they may make a comeback because those drives are now almost as fast as the chips. So if you can store the data and process it in a different location, closer to the edge, right? Closer to where you need it. All sorts of math in there with latency issues and whatnot. It's going to be some hard questions to answer, but the digital data centers probably do give us a tip as to what's going on. And I think they're less than 2 years away from going, oh boy, we suddenly don't have enough again. And that'll be good for DLR. So I haven't talked much about that company, but I wanted you to have kind of a background on it before I put out the article. Other big theme that we really have to buy, and you know the ETFs that I like, but I really like PBW because it's equal weighted and will get us more small and mid cap exposure. The climate change and environmental crisis, as somebody who watches agriculture closely and I got dirt under my nails right now, I'm telling you, it's worse than people think, and it's getting worse fast. And it's another reason I'm putting my money into Wisconsin real estate, and maybe I'll get around the Midwest too. But, you know, I like to be in the same, I like to see my stuff. So anything within 3-4 hours of Milwaukee is probably where I'm going to stick. Water, no hurricanes, got a tornado here and there, no earthquakes really. There's actually a fault line between Milwaukee and Chicago, but it's not the sort of thing that shakes very often. And when it does shake, it's news. So we have to be very married to the ideas that these major secular themes are where we need to put our money. Decarbonization is going to be a massive business. If you saw the headline today, Exxon just cut a deal with U.S. Steel to bury, 800 zillion tons of carbon or something. We know a little company that's doing that in California. I just need to make this very clear one last time until the next time. The tax credits involved with carbon capture are massive. They are designed to bail out Exxon and Chevron as we get off of fossil fuels. And we're not going to get completely off of fossil fuels. I've basically said that we'd cut our gas and oil use in half by 2040, 2050. Coal's going to be just about gone, though. Somebody asked, should we be looking to invest in carbon credits? My answer is yes, through the companies that are getting them. What are the two big fossil fuel companies that I'm invested in? One's a giant company that's backed by Berkshire Hathaway, Occidental. Occidental is right there with Chevron for leading in carbon capture and carbon technology. And then Ametis is a small company with $150 million market cap that looks like they're going to have billions in revenue in just the next few years. Dave asked, why not invest in carbon credits more directly? Because you're not going to be good at it. That's the answer. You don't have the capital. You don't have the ability to use margin. You don't have the connections. And the funds that will probably get into it are going to rip you off the same way that UNG and USO and all the other shit ETFs and ETNs that look to fuck you out of your money. There. Is that the answer you needed? Don't go swimming in a shark tank because you think that meat's going to be good, because you end up being the meat. So that's something to always know, is any futures-based ETF is going to kill you. Just kill you. Every now and then there's a rally, but then it kills you again. Take a look at the VIX chart. Take a look at the reverse splits on all the commodity ETFs and ETNs. They're just junk. Investing in good stocks, good companies that have leverage to a commodity or a tax credit is the way to go, because at some point their margins expand and you make a lot more money doing it that way. The one exception so far has been Bitcoin, where just investing directly into Bitcoin has been the winning trade. So while we can take a look at Marathon and Riot and a couple others on the mining side, the reality is that any debt that a miner has defrays their margins. So Rami actually introduced me to one company that is debt free in Australia. Actually, they're mining in the United States, but they're based in Australia. That may tend to be the exception, but as I've put up the charts for you in the past, and I show you the correlations between Bitcoin and some of the companies, it's not a winning proposition usually to be derivative in that case, because they're not really generating leverage. And I think that's because they're not really producing an end good from the commodity, in that case, Bitcoin. So Bitcoin has been the clear winner, even with its wild volatility. If you had bought Bitcoin 5 years ago, you'd be up way more than any stock. Bitcoin's been the best investment in the world the last 5 years. I suspect it could be the best investment in the world the next 5 years, which is why I'm finding ways to sneak it into retail accounts in backdoor ways. One of the reasons I love Square is because they have a great business model, and the Bitcoin on their balance sheet has been so ignored the last year that it actually will add a pop to the Square stock price at some point. So do I own Square forever, or do I look for the bottom this summer and then sell it on some FOMO rally, I don't know, 4 or 5 years out? I think that's probably what happens. But anytime you invest in a stock, of course, you want to look for multiple catalysts that can drive the share price up in case one of the catalysts doesn't work out. So we're looking for multiple reasons that a stock can do well. And with Square, it's the business model in general. And by the way, they've got a big hunk of Bitcoin on their balance sheet. And at some point, they should get a huge pop from that. Once that pop happens, now you have to reevaluate how good is Square's business model at that time in history. But stick with the big themes, the decarbonization. The real estate theme really is derivative of aging demographics and the shift in the workforce, not only due to COVID, but AI. So COVID forced us to work from home. That pushed a lot of the technology into the field. And now AI is coming to make it 5-10 times more efficient. Just saw IBM lay off another hunk of people, which is kind of ironic because they're a big AI company with Watson. Other big themes that have to do with aging demographics, healthcare. The world goes bankrupt, the whole world goes bankrupt if we don't get deflation in healthcare. So what's going to happen? There's companies out there, one that I'm going to release an article on this weekend, that I think are going to drive healthcare deflation over the next decade. The combination of client and doctor connections via technology, the data that they can accumulate, and then AI helping the doctors. What's interesting, and one of the things that Rami and I talked about, is that AI not only diagnoses and puts together better treatment plans than human doctors, but they're like 4 times or 5 times better. Because human doctors have to rely largely on trial and error. And they start with the least intrusive thing and they work their way up to the most intrusive thing. And the problem with that is that sometimes, because they started too slow or got to the right treatment too slow, the most intrusive thing ends up having to be done anyway. So the AIs, Watson ran this test a while back, are getting the diagnosis and the treatment correct 90% of the time day one. Human doctors are around 20%. 1 in 5 times they hit it right on the head. And then they work through their list. The AI lands on the right answer based on the data 9 out of 10 times, day one. I mean, it's pretty amazing. And it just relies on the right data being entered, the right symptoms being reported, the list of things that you ate and drank and traveled to and everything else, your height, your weight, genetics. You give the AI that list properly, and it's going to figure out what you need very quick. AI is having a big impact in radiology. You've heard of doctors having different opinions of what they see on a scan. The AI can read it 5 times better, it looks like. The AI sees what really is wrong. It's better than eyeballs. And there is a company that we've talked about recently that has been trending sideways for months. I think it's probably time that we dial that doc up. So there'll probably be a addition to the plug and play list for July. I'll probably announce it next week before I leave for Vegas. And I'll be looking to sell puts and take a starter position in the next 4 to 6 weeks, would be my guess. Could be August. It's a big list, but we need to focus on the best ideas because from a relative performance standpoint, decarbonization, the impact of AI, not necessarily the AI itself, but the impact of AI and the changes in the real estate market and then emerging markets. I think those things right there, I honestly, I never thought I'd be a billionaire. And I suddenly have some false hope that maybe I will be. Because the money to be made over the next 15 years is enormous if you just ignore most things and invest in only the very best ideas, which are what I just laid out for you. There might be one or two things, and there'll be derivatives of that. But decarbonization, fourth industrial revolution, with the impact of AI being a big one, and then changes in how real estate works. Because the migration of people to more climate-friendly areas has already started. It's already started. We're seeing it in Southeast Asia, and we just saw the first couple quarters of it in the United States. I mean, we're no longer in batting practice in the United States. I think that we are in the top of the first inning. I think the game just started. And this real estate pullback that we have right now, I think people are going to make 2 to 4 times their money on real estate investments in under a decade. I mean, that's just think about the certainty there, because it's real estate backed. So a lot of these people who moved to, and Nuriel Taleb talked about this. A lot of these people who moved to Texas and Florida because I want warm weather and low taxes. Well, Texas might hold up, but Florida is going to be fighting the water forever now, and it's hot, and they're not going to be able to afford to save that state with no income taxes and without getting bailed out by the federal government, in which case federal government is going to stick it to them, especially if they keep electing people like Ron DeSantis. Because at the federal level, the Democrats have such a massive advantage at this point for future elections. Combination of demographics, women being pissed about Roe versus Wade, immigration. We've seen this coming for 20 years, and it's here now. Republicans should have killed the Democrats in the midterms. And here they are going to run an 80-year-old man that's probably going to win by millions of votes again. That's how much of an advantage they have. Imagine if they ran somebody like Obama again. They'd sweep the Senate. So understand, and I understand people are ideological, and I'm just looking at the data sets. You're going to get a lot more Democratic policy, and because of the vitriol that has come from the Republicans since 2010, there's going to be payback. I would not want to be in freaking Florida when that happens. You're going to see millions of people move back to other places, and the places with river systems that are wet and are going to stay wet, Tennessee, Kentucky, probably going to do pretty well. Indiana, Ohio, maybe Pennsylvania, anywhere on the Great Lakes is going to do well. So understand what's really going on in the world and in the United States, and go back to all the things I've been saying for the last 5, 6, 7, 8, 10 years. It's all moving in those directions. All right, keep an eye out for articles so that you can get your investment solutions. Oh, somebody said, I noticed that you are a member of Catalyst Hedge Investing. So the reason why I belong to Catalyst Hedge Investing, and nobody else really needs to, is it's part of my due diligence for keeping an eye on the shorts. Because when the shorts pile into something and they're successful, if the company is a good company, there's usually a pretty great pivot point to invest. So just like we nailed Ametis at the bottom, we haven't really invested a lot of money in Ametis for a while, just watched it go down for a freaking year. And I told you, I got it to the day that you should have invested at the bottom. And some of you did. The reason I talked about Digital Realty Trust is because he has a short thesis on it, which is the same. He's saying the same things that I've been saying, but he's not also pointing to the inevitable rebound that's going to be caused by the pullback in construction on digital data centers and the fact that demand is going to go through the roof. So you had a pullback on building because they got ahead of themselves, like Amazon. Amazon overbuilt their distribution center, so they had to pull back. So, yeah, I don't know that anybody needs to belong to a service unless you really want to get active with shorting. And my opinion is that most people should not do that. It's better to let shorts be shorts, let traders be traders, and then take advantage of the pivots, because the extremes are third and fourth standard deviation moves right now. And pretty much by physical law, by the laws of nature, there has to be massive snapbacks on those unless the company really goes out of business. They are giving us a lot of opportunities, and some of the long timers here know this. When a stock price gets so low that it's basically priced to go out of business, there's only one question left to ask. Is it really going out of business? Will it be here in 5 years? If the answer is it'll be here in 5 years, you find some spots to invest. I mentioned Occidental earlier. I'm getting a question about this. I think that Occidental is a pretty easy $100 stock down the road with distributions. If you take a look at their capital structure and the fact that Berkshire is moving towards owning between 40 and 50% of the company. And at that point, why wouldn't they just buy 80% and put it on their own balance sheet and collect the tax credits themselves? Warren Buffett loves tax credits and tax breaks. I mean, he says that they shouldn't be there, but he uses them. And that's where I've gotten to in my career. I don't really think the 1031 exchanges are great. And I don't really think that step up in basis is a good thing. It only benefits 1 or 2% of the population. I mean, of all the loopholes and tax breaks that are out there, the one that maybe makes some sense is 1031 exchanges, because who else is going to allocate money to redevelop properties? On the flip side of that, somebody would say, if we just reprice everything, it doesn't matter. Well, maybe we're repricing things now. It would be a good time to get rid of 1031 exchanges or limit them to $1 million a year or something, right? Let the flippers be flippers, but, don't let billionaires carry highly appreciated asset to highly appreciated asset without at least paying the capital gains. Because that's what happens. Did you know that when people pay estate taxes, that somewhere between 70 and 80% of that money has never been taxed ever? You hear the people run around and say, well, they pay taxes their whole life, blah, blah, blah. Why tax them at death? It's a death tax. Bullshit. Most money that gets taxed at death has never been taxed before because of different ways of deferring the taxes. Teddy Roosevelt, a Republican, said that an estate tax was necessary to prevent dynastic wealth in the United States and creating a gentry of elites that control everything and are insulated from everything at the same time. They can gamble and lose and get repaid by the government. Seen it in banking a number of times. So from an economic efficiency standpoint, from a true libertarian leaning way of thinking, a lot of tax breaks are just wrong, especially when they're not directed towards policy outcomes. So the carbon credits are pointing towards a policy outcome. What is the policy outcome of letting the rich just keep more money when they die? How is that in the public interest? The ultimate upside of Occidental, though, with that policy outcome directed carbon credit, is that it could end up being a $200 or $300 stock based on what I've seen with carbon credits in the past in Europe. It'll depend on execution of management, correct? So the early money to be made in Occidental is now. This is the easy money. Buying Occidental below the Berkshire Hathaway warrant price of $59.62, right? Anytime you can buy Occidental under 60 or sell puts where your net cost is going to be under 60 is almost a risk-free trade, because you have probably the strongest financial company in the world, if not the strongest, top 10 behind that company. It's just like the core reason I've always liked Sun Power is because Total stands behind them as 80% owner. So when you can take away the financial risks and know that it's just, I might have to go through a down cycle, but there's like no financial risk long term, and there might be huge upside, why not find 20 of those and put them in your portfolio? Well, the answer is it's hard to find 20. But when you find them, when you find a company like Sun Power, when you find a company like Occidental that essentially has a patron or their own balance sheet sometimes, and it's desperately undervalued to what could go right, it's a heck of a gamble, right? I played a poker tournament earlier this year, and they had a run it twice feature where in the tournament one time you could see 2 different board cards in the middle of the table. Well, I saved my run it twice till the cash bubble, and I got into a hand behind, but I had a ton of draws. So I said, I'll use my run it twice. You have to be all in to do it. Did my run it twice, and I won 3/4 of the pot because one side we chopped and the other side I won. The guy was furious. I won the tournament. It's what got me my ticket into the Monster Stack in Las Vegas this year. So not only did I win the money that day, I got so many points in this series that I'm playing for free in the Monster Stack in the World Series of Poker. $1,500 free roll for me. I get to keep 65% of the prize money. Pretty good deal. So when you can find things like that, where your financial risk is extremely low, your upside is high and maybe super high, right? Do it. Teresa says, I said this before. My favorite tax strategy that I told clients was defer, 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 die. Right. So right now we're going to need some of that money in the next couple of decades. So we need to find a way of getting more of that baby boomer money, especially the 1%er baby boomer money, back into the economy. And that's going to, mean closing a lot of loopholes. I don't even think we have to raise tax rates. I don't. And I think that Biden, because I'm on one of those committees here in town for the Democrats, I just said over and over again, don't ever talk about raising taxes on the rich. Don't ever talk about raising taxes ever. Only talk about closing loopholes on millionaires and billionaires. Just say it like that. And you know what he did last year at the end of the year? That's what he talked about when he introduced his budget. Not going to raise any taxes, just going to close some loopholes that millionaires and billionaires use. That plays pretty good, doesn't it? Yeah. All right. I've got a lot of articles coming out. I kind of been trickling them in, but I'll tell you, there are companies that you need to prepare to buy this summer. And if we get a correction in QQQ, the easiest thing for the large cap portion of your portfolio is just buy QQQ on the next pullback. I think that we should give back the entire AI rally, at least half of it. So you're looking at a 10 to 20% correction on QQQ this summer, I think, and 20 to 30% on SPY. If I had to pick a range for those corrections, that's where I think I'd be. And if it happens that way, then you buy your QQQ. But you need to have emerging markets and small caps because they're probably going to go up a lot more because it's the law of small and large numbers, right? Small companies become big companies. Small economies grow faster than big economies. So if you have the stomach for the volatility and you can use the volatility to your advantage, you're going to make a lot more money than the guy who buys SPY or VOO. All right, let's call it a day. I got an incoming call and I think I've talked too much. All right, take care.